Something big is happening behind the scenes, and the biggest U.S. banks are sending out a final warning that most Americans are simply not paying attention to. They're tightening the rules, becoming pickier with who gets approved for credit cards, and preparing for a financial shift that millions are likely to feel very soon. If you think this doesn't affect you because you pay off your cards or don't even have one, think again. The ripple effects are already hitting households in ways that go far beyond just credit limits. Recent data reveals a sharp drop in new credit card account openings. Just last quarter, Bank of America saw 117,000 fewer new accounts. American Express reported a drop of 200,000. Even Wells Fargo reported negative 34,000 new accounts. While a few banks like Citi showed some positive gains earlier in the year, the trend across the board is unmistakable. Major banks are pumping the brakes and evaluating risk more carefully. This isn't just about protecting the banks. It's a sign that they see something on the horizon. Economic headwinds are forming, and credit is usually the canary in the coal mine. When lenders tighten up, it's often because they anticipate higher defaults, slower consumer spending, or instability in the job market. Why the caution? Inflation is creeping back in, and it's doing so in ways that many people don't immediately recognize. We're not just talking about price hikes on gas or groceries. This time, it's showing up as shrinkflation. Smaller products, same price. You've probably noticed it already. Bags of chips with more air than chips, smaller candy bars, and thinner bottles that appear unchanged at first glance. Even pet food packaging has been downsized, while prices remain unchanged or go up. This tactic is being used by companies that can't absorb higher costs anymore. Rather than raise prices directly, they reduce the size, volume, or quality of the product. One business owner shared a story about suppliers refusing to lower prices, but offering cheaper alternatives instead, like making a product thinner or shorter. For example, a common item like a back scratcher might be made with cheaper material or shortened by half. Sure, it still looks like a back scratcher, but its function is diminished. That's the trade-off companies are making just to keep up. It's not just anecdotes. It's reality for many households. A friend recently shared that his family of 4 used to stretch a box of laundry detergent for 3 full weeks. Nothing has changed. Same number of people, same laundry routine. Yet now, the same box only lasts 2 weeks. When he looked closer, he realized the packaging was the same size, but the number of loads it covered had quietly decreased. That's shrinkflation in action, and it's costing families more without them even noticing, until their wallets feel it. And while these inflationary pressures build, tariffs are another looming factor. Starting August 8th, a new round of tariffs will hit imports. But don't expect price spikes overnight. Retailers have already stocked up on inventory to delay the impact. Still, over the next 6 to 8 months, you'll likely begin to notice higher prices as those stockpiles dwindle. Some companies might try to eat the cost for a while, but many can't afford to, especially the smaller businesses. So, they'll pass it on to you, the consumer. So what can we take from all of this? Whether it's the banks tightening access to credit or the slow but steady rise in daily expenses through shrinkflation and hidden price hikes, the financial warning signs are flashing. If the largest banks are preparing for a downturn by restricting credit, we should be preparing too. Whether that means paying off debt, budgeting more carefully, or simply being aware of how much less we're getting for our money. Because make no mistake, the cost of living is going up. And the way it's happening this time, you might not see it until it's already hit your bank account.